Hello, everybody. I hope this video finds you well. My name is Evan Cowan, and I'm the Participant Services Specialist at Cornerstone Advisors Asset Management located in Bethlehem, Pennsylvania. Cornerstone serves as the investment advisor to your retirement plan, and we felt it made sense to put this video together that goes over some of the savings and investing best practices for retirement plan participants during volatile markets. Up until the end of last year, over the past decade, the S&P 500 had averaged 16.55% a year. What we have seen so far this year in 2022 is a pullback in the 10 to 12% range. Some of the things that have and continue to impact the market are challenges with inflation, potential interest rate increases, supply chain roadblocks, as well as geopolitical events such as the war in Ukraine. So while investors have enjoyed favorable markets for the past decade, I think a lot of investors are on edge right now, especially if you're approaching retirement. This video is meant to provide some perspective, but also to remind you that we're happy to meet with you individually if you would like to review your investment strategy. This is a really interesting chart that tells us a lot about market volatility and the importance of staying invested. As you can see, the blue bars represent the S&P 500's annual return dating all the way back to 1928. The purple dots represent the maximum drawdown throughout the course of the year. So again, what these blue bars are showing is what was the S&P 500's annual return over all of these years, and what the purple dot is showing is what was the lowest point that the market had gotten to throughout the course of that year. So what you'll notice is if you were to draw an imaginary line across this negative 10% rate of return and also negative 20% rate of return, you'll see how common some of these pullbacks can be. And so while we understand that a lot of the volatility can be unsettling, history does suggest that this is fairly common, especially considering how strong the markets have been over the past several years. 68% of the time, the market generates a positive rate of return, and 32% of the time, a negative rate of return. There's been 26 years when the market has been up by 20% or more, compared to only 6 years when the market was down by 20% or more. So as investors saving for retirement, it's really important to maintain a long-term perspective and to understand that you will most likely be investing not only to retirement, but throughout your retirement. So being familiar with your asset allocation and your time horizon are both really important. And again, we'd encourage you to sign up for a one-on-one if you have any questions related to either of those. This slide does a good job of showing how powerful increasing your contributions can be. When you take a look at Ethan in the middle, Ethan started out saving 3%, but committed to increasing his savings 1% a year until he stopped at 10%. By the time Ethan got to retirement, you can see how impactful those increases were when compared to Sarah, who stayed at 3% her entire career. So we understand that everybody starts at a different percentage. Some people it's 3, 5, 7, 9. We always encourage everybody to save at a level that you're comfortable with, but get in the habit of bumping up your contribution by 1% annually. Again, Sarah and Ethan both started at 3%, but Ethan committed to saving 1% more until he stopped at 10%. And when all is said and done, Ethan had was a lot closer to Sam in this example, who had started at 10% and stayed at 10%. So again, just a great example that shows the power of increasing your contributions annually. Here's another pretty good example of that. It shows the difference between 6% versus an 8% contribution. You can see over 25 years that can equate to close to $100,000 difference. So every time you increase your contribution by say 1 or 2%, that increases the likelihood of success very dramatically, but also increases how much money you're projected to have at retirement by possibly tens of thousands of dollars. So again, a really important habit to get into is trying to increase your savings. Okay, so now that we talked a little bit about increasing our savings, I wanted to talk a bit more about the importance of staying invested over time. So this is an example that shows, a hypothetical portfolio of $100,000 back in 2008, 2009 during the financial crisis. $100,000 would have dropped down close to $50,000, and that investor, if they would have stayed invested in the market, all these years later would have been closer to $290,000. Now, if that person were to exit the market and decided to reinvest 1 year later, they would have only had 218,000 compared to the 290 that they should have had. And you can also see if that person were to exit the market and hold in cash, how significant and really detrimental that decision would have been. So history would suggest that staying invested over time is really important. You should be focused on time in the market and not timing the market. So I wanted to review the two types of contributions that can be made inside of your retirement plan. You're likely already familiar with the pre-tax. That's the traditional way of saving for retirement, where contributions are made before taxes. So the money comes out of your paycheck and into your account, and you have not paid taxes on it. And you will pay tax on the money when it's withdrawn during your retirement. The benefit is that you won't be working anymore. You won't have earned income. So presumably you'll pay a lower tax. So you're saving money, you're investing money, you're deferring the taxes till later on down the road. However, you will pay taxes during retirement. I will add that the employer contributions, if you receive one, are always a pre-tax contribution. Now, on the other hand, Roth contributions are made after taxes. So no taxes are paid when the money is withdrawn because you've already paid them when you made the initial contribution. So really, do you want to pay the taxes now or do you want to pay them later? And if you get the taxes out of the way with now, otherwise known as a Roth contribution, that's a great way to generate tax-free income at retirement. And so whether or not a Roth contribution is right for you is based off a couple things, primarily your age and income, expected tax bracket at retirement, your years until retirement, your needs upon retirement, and expected sources of income. I will add, I apologize, I missed this, that when you make a pre-tax contribution, you get a tax deduction. So the money that you save reduces your current taxable income when making a pre-tax contribution. When making a Roth contribution, you do not get that. You do not get to reduce your current taxable income, but you do get tax-free withdrawals at retirement. So again, you are allowed to do both pre-tax or Roth. And by doing so, that gives you a little bit of tax diversification when you get to retirement. Again, if you have any questions, we're happy to have a conversation with you as it relates to what's the most appropriate contribution type for you to be making. So lastly, I just wanted to make sure that we added this in the presentation to make sure everybody has their beneficiaries up to date so that, God forbid anything were to happen to you, your retirement savings are distributed the way that you would want. If you don't name a beneficiary, generally your savings will automatically go to your spouse. So again, it's important to have them up to date. If you name a minor, you'll need a designated custodian to manage the money on their behalf. So if anyone's gone through a life event, such as divorce, remarriage, birth, death in the family, it's important to make sure that they're up to date and according to your liking. So hopefully you found this video helpful. Please sign up for a one-on-one by holding your phone to the QR code in the bottom right-hand corner. We're happy to review saving strategies and review your asset allocation. Really, any questions you have about the plan, we're happy to answer. So hopefully you found this video helpful, and we look forward to speaking with you shortly. Thank you.